market continues to trade in the bloodbath as we continue to see a broad base of risk-off scenario as we are speaking right now on Monday, the Asia Pacific session. The S&P 500 E-mini futures and the Nasdaq 100 E-mini futures extended its losses by negative 0.3%. And last Friday, both the S&P 500 and the Nasdaq 100 recorded its fourth consecutive weekly losses, hitting a fresh 6-month low. And very interestingly, Gold XAU/USD did not benefit in this rising geopolitical risk premium due to a risk of stagflation risk rising on the horizon as well. That actually saw the Fed rate cuts bets for this year totally eradicated based on the CME Fed Watch 2, and gold continues its decline after breaking its key 50-day moving average last week, triggering off a medium-term downtrend scenario. And as we are speaking right now in the Asia session, it's down by close to negative 3%, trading below this February low that was seen previously at around the 4,400 level. And oil prices continues to help firm above the $95 US dollar per barrel in the West Texas crude oil. Very good morning to all and welcome back to another volatile Monday. As we are speaking, today will be the 23rd of March 2026, Monday. I'm Kelvin here. So before we start the gist of today's daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So before we jump straight into today's volatile session, which I will cover the full suite of all the intraday technical outlook with fresh technical levels to watch on the broad-based cross asset classes. Let's have a recap what has taken shape last Friday weekend and as well as in early today's Asia session. So let us start with last Friday's crux of the global markets, which will be the ongoing US-Iran conflict/war that is now entering its 24th day without any sign of de-escalation. And over the weekend, instead, Trump actually upped the ante by threatening now to chop off Iran key economic assets that include power facilities. All right, not the oil. So previously he threatened to hit the oil facilities, but right now he decided to go with power facilities by totally crippled down Iranian's economy. So what Trump's did over here on Saturday, he actually gave a deadline on Iran to actually reopen the Strait of Hormuz. So we know that the Strait of Hormuz is a very important global oil flows choke point that is being very near the Iranian coast, where Iran is able to actually send their own, put away that military assets to harass non-friendly oil tankers passing through the Strait of Hormuz, which I think contribute close to about more than about 20% of oil flows that's flowing through there. So with that created a significant oil supply shock. So we sent oil prices higher, and that created a ripple effect on the global markets as well. That means, i.e., we start to see stagflation risk rising. Later I'll share with you what is the pricing of the CME Fed Watch 2, which is taking into account of the Fed Funds Futures Traders price action in relation of assigning a probability whether the Fed will be hawkish or dovish going forward. And with stagflation risk rising, that also create a higher cost of holding precious metal. And we know that precious metal is non-interest income bearing over here. So that actually saw gold prices falling off significantly as well last week, which I highlighted in my daily dose a while back as well. But what's interesting over here is that given US President Trump threat over the weekend, giving Iran a two-day deadline, that means 48 hours. So he actually released this threat on Saturday. That means today will be the last day over here. So, but however, Iran side continues to play the hardball. It countered that if its power facilities were to be attacked by US and its allies, it will totally shut down the Strait of Hormuz completely and target all energy, information technology, and desalination infrastructure linked to US and Israel. That means this is very, very crucial for the Gulf states. That means we know that information technology refers to data centers that is being built by US mega cap technology corporation in the Middle East due to that billion-dollar deal that US and Saudi Arabia signed and some of the Gulf states earlier on last year. And desalination infrastructure is, we're talking about clean drinking water reservoirs, all right, or plants that are what I call it, producing clean water in the Gulf states, which is pretty much crucial as well. So what Iran's trying to do is Iran trying to play the hardball game by totally crippled the economic structure of the Gulf states, in turn pressuring the Gulf states to totally deassociate from the US and Israel, and also hoping that the Gulf states will press US to stop their attack on Iran. So what we could see on the near-term horizon, that there is no signs of de-escalation. So without any sign of de-escalation, oil prices could hold much firmer, and that could create that stagflation risk, which is creating this ripple effect on the global markets right now. All right, so stagflation risk, what it means that liquidity will be tightened in the US economy, where the Fed will start to, instead of cutting rates, they will start to pause for a long period of time, and there could be a risk of introducing interest rate hike in the US again. And how do I decipher that? Is by looking at the CME Fed Watch 2. So CME Fed Watch 2, for those who follow my daily dose of market insight, it's not really a live pricing. Is out there is a slight delay of 1 to 2 hours based on the Globlex traded Fed funds futures market over here. So CME Fed Watch 2 did a calculation based on the pricing behavior of the Fed funds futures traders in the Fed funds futures market. So we know that the current Fed funds rate is at 3.5% to 3.75% over here. And across this aggregator tab, you'll see the rest of the meeting calendar this year. That means the meeting dates of the next FOMC meeting this year, all the way until next year, 8th of December 2027. So bear in mind, this date here is American standardized, not UK standardized. So what you see on the first figure here is April the 29th, 2026. All right, so it's month, day, year. So on the next meeting, which is 29th of April, market is assigning a high odds that there will not be interest rate cut at all. It will stand pat all the way until end of the year, which is 9th of December 2026. So previously, we see a slight chance of an interest rate cut by the end of the year. So right now, this slight chance got totally evaporated. All right, so 75% chance that the market will stand pat at 3.5% to 3.75%, and even market is assigning a high odds of, not high odds, a higher odds right now of 35% chance that the Fed will introduce a rate hike on the last meeting of this year in December. Okay, so it's either October or December this year. All right, October 35% chance, December 24% chance. All right, to introduce another 25 basis point hike to bring the Fed funds rate higher to 3.75% to 4%. And the next interest rate cut in this ongoing interest rate cut cycle. So bear in mind that the Fed has an interest rate cut cycle introduced late last year, where they cut the Fed funds rate 3 times. And for this interest rate cut cycle to continue after a long pause, that will only come in the end of next year, which is the 12, not end of next year, sorry, towards the third quarter of next year. That means 12th of end of next year, because this is month, date, year, American standardized dates over here. All right, so by the end, only the end of next year, that means 8th of December 2027, there is a 64% chance that the Fed will introduce a rate cut to bring it down to 3.25% to 3.5%. So what we are seeing right now is at the start of the year, we are expecting three or two interest rate cuts. So right now, no more interest rate cut is being priced in the Fed funds futures market. And instead, there is a risk that the Fed may introduce a rate hike that hasn't hit 50% yet, but the odds has been rising because right now we see a 35% chance and a 24% chance on the 28th of October meeting this year and the 9th of December meeting this year to bring it back up to 3.75% to 4%. And the next interest rate cut has been pushed down the calendar way down until late next year, which is the 8th of December 2027. So because of this stagflation risk, it's now creating a liquidity squeeze in the market. So liquidity squeeze in the market is not good for stocks in the near term, all right, because equities thrive on looser liquidity environment, all right, because higher liquidity environment, it means that i.e. corporation will not be able to get easier access of financing, and that could actually cramp down net profit growth. So what we could see is across the board, we see a sell-off in the US major stock indices last Friday, the S&P, the Nasdaq, the Dow Jones, and the Russell 2000. And right now, the S&P, the Nasdaq, and the Dow Jones all are trading below the 200-day moving average, and the Russell 2000 is challenging the 200-day moving average. So the worst hit was the Russell 2000 on Friday, given that their small cap company balance sheet is much more highly levered compared to the companies in the S&P 500. So the Russell 2000 was the worst hit on last Friday, down negative 2.26% due to this tighter liquidity condition in the US, which I explained earlier in the pricing of the CME Fed Watch 2. The Dow Jones Industrial Average down by negative 0.96%, the Nasdaq 100 down by negative 8.9%, and the S&P 500 down by negative 5.1%. Okay, negative 1.51%. And as we are speaking right now, both the E-mini futures, the S&P 500 E-mini futures that is trading right now during the Asia session at 11:13 a.m. Singapore time is down by negative 0.24%, and the Nasdaq 100 E-mini futures as it's trading right now in today's Asia session at 11:13 a.m. Singapore time, it's down by negative 0.33% over here. And if you look at the heat map of the S&P 500 last Friday, a sea of red except some pockets of green in the energy stocks over here, given firmer oil prices, is creating a positive feedback loop in the energy sector in the S&P 500 key 11 sector. So if you look at the 1 week performance, yes, as of last week, the only sector that is deeply in the green will be energy, positive 3.23%, and the rest of the 10 sector are deeply in the red over here. All right, so if you look at it, it's more or less a very clear risk-off scenario in the US stock market, with the acceptance of some energy stocks that is able to lead to the outperformance, positive outperformance of 1 week last week in the energy sector, gaining positive 3.23%. All right, over here. And with that, let me share with you the situation in the dollar as well. So what we could see is that the US dollar index managed to find support at the 20-day moving average, and also the ascending trend line support that has been in place since the low of this year, which is 28th of January 2026. So it managed to find support on last Friday, bouncing off the 20-day moving average at 99 figure level. That also confluence with this ascending trend line support since the low of this year, which is 27th of January, pardon me, at 95.55. And right now is retesting the key medium-term range resistance level zone at 100.10 and 100.54 again. has been in place since 28th of May last year. This complex sideways range configuration, medium-term range resistance looking to retest again at 100.10, 100.54. So what we could see is stagflation risk, stagflation risk rising. Here is the linking of the dots, leading to the Fed being less inclined of cutting rates. And right now, the CME Fed Watch 2 showing the Fed funds futures market, there is a risk of hiking rates instead. Not really a 50% chance, but a chance of between 25% to 25%, 35% to 25%. That was not being seen at the start of this year. And right now, due to this rising stagflation risk, we now see a small chance of the Fed hiking rates by the end of this year. And the next interest rate cut has been pushed down all the way down the calendar until end of next year. So that causes the dollar to firm as well. And with the dollar firming up, we will start to see the longer term US Treasury real yield rising. So what you could see over here is that this particular chart here is the intermarket analysis between the US long-term fixed income rates and the price action of gold XAU/USD. So the top of the chart is the 10-year US Treasury real yield. That means taking into account of the 10-year implied inflation expectation 10-year from today. So you minus off this with the 10-year nominal Treasury real yield, it give you the 10-year Treasury real yield. So 10-year Treasury real yield is basically the nominal 10-year Treasury yield minus off the 10-year break-even rates. That is inflation expectation in the US. So what we could see is that it has been trading in this major descending channel since 28th of October 2025 high. So it's been trading inside this down of this channel, and that also saw a strong rise in gold prices as well. But ever since it's began to find support at the 1.66%, that has been seen since late February this year, 27th of February, it starts to show a strong bounce, and this strong bounce has starts to see gold prices collapsing as well. If you look at the movement of the US 10-year Treasury yield and gold, it has an inverse relationship. That means a bounce off in the 10-year US Treasury yield, indicating that the interest rate, long-term real interest rate in US has starts to rise. And we know that if I were to be a holder of gold, that means I buy gold, it will lead me to higher opportunity cost of holding gold, because gold itself does not produce any fixed income. That means it's a non-interest income bearing asset. So with longer term US Treasury interest rate, real interest rate rises, that created a higher opportunity cost of holding gold. That means that would also see lesser demand of gold, and worse still, if gold is being seen as a speculative asset in the last 3 to 4 months, where people use leverage to long gold, it created a further negative feedback loop impact of it. All right, so what you could see now is that as of last Friday, is a daily chart, it managed to clear above this range configuration resistance at 1.98%, and also cleared above the 200-day moving average. And in today's Asia session, it's trading at 2.03%, and it appears to en route up to retest 2.09% and 2.2%, which is the long-term pivotal resistance of this 10-year US Treasury yield. We are so close to the upper limit of this major descending channel that has been in play since 23rd of October 2025. So with this positive medium-term movement on the US 10-year Treasury yield, it would definitely lead to a higher chance or higher probability that this weakness that is being seen in gold after breaking below 4,985 last week, which is the 50-day moving average, may not pause right now. And the next support level is 4,085. Breaking 4,085 will potentially see deeper losses on gold price, as right now gold is likely in the midst of undergoing a medium-term downtrend phase due to this intermarket relationship with the 10-year US Treasury yield that is showing further upside potential towards 2.09% and testing the long-term pivotal resistance level in first step at 2.2%. All right, so that is the reason why gold is trading so weak right now due to that stagflation risk, and that created higher opportunity cost of holding gold because of a rise in the 10-year US Treasury real yield. Okay, so that sum up the first segment of the daily dose. All right, so let me now move on to the second segment, which is the intraday technical outlook segment. All right, so with that, let me expand my screen. Okay, so let us start with the FX market over here. Okay, hopefully the screen is good. All right, so let us start with the euro dollar. So euro dollar last Friday, we do have a mild bullish bias using 115.18 short-term pivotal support level. So far, it's been trapped within this range. It can't clear above our first resistance level at 116.05. That has been met on last Thursday due to that much more hawkish vibe coming out from ECB monetary policy meeting. And now this 116.05 also confluence with this downward sloping 20-day moving average very closely. So with this push up in the US dollar index, I will not have any conviction right now to continue this mild bullish bias in the euro dollar. So instead, I will flip to a neutrality stance for today. So neutral between 116.05 and 115.20, breaking below 115.20 with an hourly close below it will trigger off a intraday bearish bias view on the euro dollar to retest 114.55 in first step, followed by 114 figure level. Next up will be the sterling pound over here. So the sterling pound broke below our Titan short-term pivotal support level on last Friday at 135.70, invalidating the mild bullish bias to see the extension of this mean reversion rebound scenario to extend further towards 135.05. And with that, I will flip to a neutrality stance for today. So neutral between 135.70 and 132.60. Breaking below 132.60 will trigger off another round of bearish leg on the sterling dollar to expose 132.20 followed by 131.80 in the first step. Next will be the Aussie dollar over here. Let me expand the screen. Okay, so the Aussie dollar also broke down below the 15 short-term pivotal support level that we have after it fails to clear above 71.40, 71.20, 71.20, 71.40 first key intermediate resistance level. And right now, it's now testing this 50-day moving average at 69.80. And based on a technical chart pattern right now, the price action since the low of 3rd of March has started to involve a bearish minor head and shoulder formation. All right, so let me draw the head and shoulder. Okay, so this is the left shoulder. Okay, this will be the head, and this will be the right shoulder. Okay, and now it's testing the neckline support of the shoulder in this gray line here. Let me put it in darker gray, and also close to the 50-day moving average at 69.80. So with this emergence of this minor bearish head and shoulder reversal chart formation, I will flip to a bearish bias on the Aussie dollar for today using the short-term pivotal resistance at 70.64, which is this 50-day moving 20-day moving average as well. And if you do the Fibo retracement of the last leg of minor decline from last Friday US session high all the way down to the low of today's Asia session, that also confluence with the golden ratio of 61.8%. And with that, breaking below 69.80 will trigger off this bearish head and shoulder formation chart pattern, extending further potential weakness towards 6944, followed by the key medium-term pivotal support at 6910 on the Aussie dollar. Only a bullish breakout and the hourly close above 70.64 will negate the bearish pressure and see a squeeze up to revisit the resistance of the right shoulder, which confluence with 71.20 and 71.40 again. Right, so that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen also continues to trade pretty strongly up. breaking above our pivotal support level at 159.10 area yesterday, pivotal resistance level. So initially we have a view on last Friday for it to break down below 51.5740, at least a retest of it before exposing the 50-day moving average at 156.55 due to that earlier much more hawkish guidance coming out from the dollar yen. But right now, market is now looking at that stagflation risk coming out from the global economy, where the US Federal Reserve will start to turn much more hawkish than earlier anticipated. Hence, that created a much more we call it a positive movement on the dollar yen. So with that, I'll be looking at two support level to watch for today. The first support level will be today's Asia session low at 159.06, which was also previously last Friday close to the short-term pivotal resistance zone as well that got taken out. Pivotal support will be at 158.30 over here, which is the minor swing low of 20th of March over here. And if you were to do that Fibo retracement after the retest on its 20-day moving average on last Thursday US session to today's intraday high, that also confluence with the golden ratio of 61.8%. So using 158.30 as my short-term pivotal support level, flip to a mild bullish bias on the dollar yen as it continues to head northwards to revisit the inflation risk zone of 160.23, 160.74. Above it, potentially see a retest at the long-term pivotal resistance level of 161.70, 161.95. Only a bearish reversal and hourly close below 158.30 will invalidate this mild bullish bias on the dollar yen to allow the best to take hold again on the intraday basis to retest 157.50, 157.40. Below it exposes the 50-day moving average that is confluencing with the minor swing low of 5th of March at 156.55. All right, so now let us now proceed to the major stock indices over here. Let me expand my screen. Okay, starting with the Hong Kong 33 representing the Hang Seng Index. So the Hong Kong 33 also did a bearish push down as expected, and as we are speaking right now is breaking down below this 24,765 former long-term pivotal support level. So with that, I will tighten my short-term pivotal support to 24,465 for today. Okay, so this will be the next resistance level to watch. Okay, tighten the pivotal resistance level to 24,765, former long-term pivotal support that got taken out in today's Asia session. Intermediate support level 24,275 over here, which is the lower limit of this medium-term descending channel from the high of 29th of January, and also the 0.618 Fibo extension taken down from the high of 29th of January as well. So once it hit this 24,257, there could be signs of a minor bounce. So after this minor bounce, as long as this minor bounce didn't surpass above the tightened short-term pivotal resistance level of 24,765, potentially we may see further weakness on the Hong Kong 33 to expose the next resistance level at 23,760, 23,670, which is the 0.764 Fibo extension on this ongoing corrective decline from the high of 29th of January. And if you go back in time over here, it's also the minor swing low area of 4th of July and 7th of July last year. Okay, so only a bullish breakout and hourly close above 24,765 will invalidate today's direct bearish bias view to see a minor mean reversion rebound scenario unfolding, retesting 25,186. Breaking above 25,186 will see a steeper mean reversion rebound towards 25,650, 25,800, which confluence with the 200-day moving average and the 20-day moving average. Okay, so that's for the Hong Kong 33. Next up, will be the Japan 225. So the Japan 225 representing the Nikkei 225 tumbled down as expected. And right now the RSI has just exited from the oversold level, right? The RSI has exited from the oversold level, pardon me. So there could be a risk of a minor bounce. So minor bounce, first resistance level to watch, 52,135. Breaking above it may see it coming close to my Titan short-term pivotal resistance level at 53,230, 53,628, which was last Friday high over here. So with that, I'll be looking for any chance to fade this rebound as well below 53,230, 53,628 adjusted Titan short-term pivotal resistance for today. Next resistance level, next support level to watch will be 50,160. Breaking below 50,160 may potentially expose 48,835, slightly above the long-term pivotal support at 48,240 and 48,835 confluence with the 0.674 Fibo extension of this ongoing corrective decline since the current all-time high that was printed on 26th of February this year. Only a bullish breakout above 53,628 and the hourly close above it will trigger a much more deeper mean reversion rebound scenario, exposing the next two resistance level at 54,355, 55,130, that confluence with the 50-day and the 20-day moving average as well. Next will be the Germany 30. That's representing the German DAX. So the Germany 30 also tumbled down as expected. So for today, I will have an adjusted Titan short-term pivotal resistance level, which is the former minor swing low of 9th of March and 20th of March at 22,747. So I'll be using any scenario to fade the strength below 22,747 Titan short-term pivotal resistance level on the Germany 30. Next support level to watch, 21,930, 21,830. Breaking below it exposes 21,523, 21,135. If you go down, it will be the congestion area of 15th of April to 22nd of April last year, and also close to the lower limit of this medium-term descending channel that has a minor descending channel from the high of 27th of February this year. Only a bullish breakout above 22,747 and the hourly close above it will trigger off a mean reversion rebound scenario towards 23,280. Breaking above it may expose 23,930 next, which also confluence very closely to the downward sloping 20-day moving average. Right. Okay, let's now focus on the major US stock indices, starting with the US Wall Street 30, that's representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average also tumbled and hit our support level last Friday as well. So now I'll be using any potential bounce to fade the strength, given that the RSI is now back towards the oversold level again. There's a risk of a bounce. So first bounce resistance zone to watch will be at 45,890. 46,060 level using last Thursday former minor swing high, and that was also last Thursday high, and that was also the broken down of the 46,330 former long-term pivotal support, now turns into a Titan short-term pivotal resistance for today. So using 46,330 as my Titan short-term pivotal resistance, I will use this opportunity, any bounce to fade the bounce and maintain a bearish bias scenario on the US Wall Street 30, representing the Dow Jones Industrial Average. Next two intermediate support level to watch, 45,237, 45,190. Breaking below it will expose 44,975, 44,810, which is the 1.382 Fibo extension of this ongoing medium-term downtrend phase that has been intact since the current all-time high of 10th of February, which is at around the 50,500 zone. All right, over here, and also the lower limit of this minor descending channel that has been in place since the high of 26th of February this year. Only a bullish breakout and hourly close above 46,330 will invalidate this direct bearish bias view on the US Wall Street 30 to trigger off a mean reversion rebound scenario to retest 46,710, which is the upper limit of this minor descending channel, and so confluence with the 200-day moving average. Breaking above it may see a steeper mean reversion rebound scenario occurring, challenging the next intermediate resistance level at 47,338, which is the minor swing high area of 17th of March and 18th of March. Next will be the SPX 500. So the SPX 500, okay, give me a minute. Okay. So the SPX 500 also tumbled down as expected, hitting our support level at 6,535, 6,500. And right now it's also hover around the oversold area. So given as it's now as the oversold area, there could be a chance of a bounce. So first bounce resistance level to look will be at 6,550, 6,550. So that was last Friday US session high during the last trading hour in the US session. And I'll be using this very clear former minor swing low of 9th of March and 19th of March that has been broken down previously. And if you do the Fibo retracement of this last leg down after it, last minor leg down after a retest at its 200-day moving average on last Thursday, it also confluenced with the golden ratio of 61.8%. So I'll be using a Titan adjusted short-term pivotal resistance on the SPX 500, 6,585 short-term pivotal resistance for today to use this resistance to fade any rebounds below it and maintain a bearish bias on the SPX 500. Next support level after 6,470 will be 6,420, followed by 6,360, which is the 1.236 Fibo extension of this ongoing minor descending channel from the high of 26th of February. And this 6,360 also confluence with the graphical swing low area of 22nd of August over here last year. All right, only a bullish breakout and an hourly close above 6,585 that will invalidate today's bearish bias view and trigger off a minor mean reversion rebound scenario to expose the next intermediate resistance level at 6,648 that also confluence with the 200-day moving average. Breaking above 6,648 may see the mean reversion rebound extending further towards the upside towards 6,718, which confluence with this medium minor descending channel resistance drawn from the high of 26th of February. So that's for the SPX 500. Lastly will be the Nasdaq 100. So the Nasdaq 100 also plummeted down as expected, hitting our support level that we have on last Friday, 23,955, 23,840. As it's now also hovering at the oversold region, there could be a risk of a bounce. So bounce first resistance level to watch 24,030, maximum 24,110, 24,280. So using a slightly adjusted downward short-term adjusted Titan short-term pivotal resistance zone for today, 24,210, 24,280 short-term pivotal resistance on the Nasdaq 100, using any opportunity to fade a rebound right below this 24,210, 24,280 Titan short-term pivotal resistance, maintain a bearish bias view, breaking below today's Asia session low at 23,738 as we are speaking right now, 11:38 a.m. Singapore time, may expose the next intermediate support zone at 23,506, 23,400. Below it sees further weakness towards 23,150, which is a 1.382 Fibo extension of this ongoing, we call it minor downtrend phase since the high of 26th of February, and 23,150. If you go back over here, the graphical area is the congestion area of 3rd of September, right? Only breaking above 24,280 with an hourly close above it, that would invalidate the bearish bias view on the Nasdaq 100 for today to see a mean reversion rebound unfolding to retest the 200-day moving average, confluencing at this next intermediate resistance zone of 24,430, 24,549. Breaking above it may expose 24,787 next, the next intermediate resistance level to watch, which confluence with the 20-day moving average, and as well close to the medium-term descending resistance that has been in place since the high of 28th of January this year at 2026. All right, so that's for the Nasdaq 100. Next up will be the commodities market, which is gold XAU/USD. So gold last Friday, we attempting to have a mild mean reversion rebound towards this 4,775 area, 4,860 area. But unfortunately, the mean reversion rebound didn't extend towards as desired, and it broke down below our previous short-term pivotal support level at 4,554 over here. So right now it's enrolling towards the next support level. So from now I would use I would actually use this area here, 4,554, 4,575 as my short-term pivotal resistance zone to fade any potential rebound that may take shape, given that it's now approaching this oversold level again over here. So flip back to a bearish bias view on gold XAU/USD as it continues to evolve within this impulsive downward sequence. Support level to watch 4,274, followed by 41,067, 41,130. Then thereafter, it will be followed a test on the 200-day moving average, close to this 4,087. All right, so you go back 4,087. Okay, you'll be this congestion area here. Let me draw it back again. Okay, 4,093. 4,093. Right, so that will be the key 200-day moving average. Only a bullish breakout above 4,575 tighten short-term pivotal resistance for today that would invalidate the direct bearish bias view and see the mean reversion rebound unfolding again to challenge the medium-term pivotal resistance zone of 47.36, 47.75. Right, so that's for gold XAU/USD, flipping to a bearish bias view as this impulsive downward sequence continues to unfold using short-term pivotal resistance zone at 45.55, 4,554, 4,575. Lastly will be the West Texas crude oil. So the West Texas crude oil continues to be held above this sideways range at 92.60 over here, but it continues to trade a series of higher low as being printed by this minor ascending trendline support that has been in play since 26th of February 2026. So given that it couldn't break above 102.25, but with a series of higher low that is forming, I will have a bias towards a potential bullish breakout of this sideways range configuration that has been taking place since 16th of March. That means we're talking about last week. So breaking above 102.25, which has a higher probability right now due to this series of higher low that's being formed on this ascending trendline support that has been in place since 26th of February. Breaking above 102.25, bullish exit exposes the next resistance level 111.28, 0.674 of this ongoing bullish impulsive upmove sequence on a minor time scale since the low of 11th of March, and above it seek out the current 4-year high that has been printed on the West Texas oil on 9th of March at 1116.56, 1119.54. Right, so West Texas crude oil potential bullish exit from this neutrality zone of 102.25. All right, even though it's still being trapped in this sideways range, but its price action continues to be rather constructive on the positive note, given the series of higher low that has been formed right exactly after the retest of this key minor ascending trendline support that has been in place since the low of 26th of February. All right, so that's for West Texas crude oil. Next up will be the economic calendar. So let's take a look at the economic calendar for today. What are the key data to take note for? All right, so let me go up to the calendar, switch it to this week over here. So today, Monday, 23rd of March. So on Monday, not much of a major tier one data across the major economy, with only the Eurozone coming in. You have the Eurozone consumer confidence flash data for the month of March out at 11 p.m. Singapore time today. Market is expecting a further deterioration to -15 from the previous month of -12.2. And at the same time, we have a ECB official speaking, ECB Sepolon. And at 12 a.m. Singapore time, Tuesday, 24th of March, we have ECB Lane speaking as well. And that is the key data / event to look out for today's session. And in tomorrow early Asia session, before the start of our daily dose at the usual timing of 11 a.m. March the 24th, Tuesday at 6 a.m. Singapore time, we have tier one data to take note of will be Australia flash manufacturing PMI and services PMI for the month of March. So that could influence the Aussie dollar, the Aussie crosses, and the Aussie ASX Australia 200 CFD index. Then at 7:30 a.m. Singapore time, we have Japan core inflation rate. Market is expecting a slight dip to below 2% to 1.7%. So that could also influence the dollar yen and the yen crosses, and as well as the Nikkei 225 in some form. And after that, at 8:30 a.m., we have the preliminary Japan flash manufacturing PMI data and flash services PMI data for the month of March. So that will be 8:30 a.m. Singapore time. All right, so that sum up all the we call it key insights that I wish to share with you guys for today's daily dose of market insights. So I wish you guys a great day ahead. It's going to be another volatile session again as well, and do practice proper risk management in such scenario. Okay, so with that, have a great day ahead, and we shall speak again tomorrow. Thank you.